Tesla is up almost 20% since the earnings call. So today, let's see exactly what were discussed at the call. In the beginning, Musk shared 4 important updates and hurdles that Tesla faced in the quarter. First, about execution headwind. Tesla navigated through some unexpected challenges, notably with the ramp-up of the updated Model 3 at the Fremont factory, and this resulted in 9% drop in the total number of cars delivered in the quarter. Also, there was a macro headwind of a noticeable global slowdown in EV adoption, where competitors seem to lean towards plug-in hybrids. However, Tesla has steadfastly pursued its commitment to fully electric vehicles, and it remains confident that full EVs will eventually lead the market. On the other hand, there were some good news coming from the energy storage deployments. Tesla's Megapacks has not only hit a record high, but also spearheaded unprecedented profitability in the energy sector, a segment poised for faster growth than the automotive sector in the coming years. For your information, in our Tesla model, we already reflected this energy segment to reach more than $20 billion in revenue by 2030, so it's going to be reflected in our final valuation number of Tesla. Next, about the production roadmap, Musk reported that the pace has accelerated with significant updates to the vehicle lineup and some production timelines being pulled forward, possibly starting as early as late 2024. These new EV models, which include more budget-friendly options, will utilize both the next-generation platform and the current ones, all without the need for new factories or production lines. This strategy is expected to boost efficiency dramatically and help Tesla surpass a production target of 3 million vehicles. Third, on autonomous driving, Musk claimed that the launch of full self-driving version 12 has been a landmark achievement. Currently, it's active in approximately 1.8 vehicles across North America, and usage rates are climbing weekly, and the technology has accumulated over 300 billion miles of supervised self-driving, validating Tesla's vision-based neural network approach to the autonomy. In a push to increase accessibility, Tesla has cut the FSD subscription price to just $99 per month, which they hope will further boost trial and adoption rates. Finally, Elon Musk looked ahead and highlighted significant strides in Tesla's AI capabilities, which are now turbocharged by major infrastructure upgrades. Tesla's AI training capacity saw a dramatic escalation in Q1, with computing power more than doubled. This includes the activation of about 35,000 H100 units, and there are expectations to activate up to 85,000 by the end of the year. And on August 8th, Tesla plans to unveil Cybercab, a purpose-built robotaxi. And in its presentation, Tesla showed a preview of this ride-hailing app. In the concluding remarks, Musk re-emphasized Tesla's commitment to an autonomous and electric future, likening non-autonomous gasoline vehicles to riding a horse and using a flip phone. Moving on, let's take a detailed look at Tesla's financial performance. In Q1, total revenue saw a decrease of 9% year-over-year, coming in at $21.3 billion. Breaking this down further, the automotive revenue was the hardest hit, down 13% at $17.4 billion. However, it wasn't all declines across the board. Revenue from energy generation and storage grew by 7% to $1.6 billion, and services and other revenues impressively jumped by 25% to $2.3 billion. This revenue decline can be attributed to 3 main factors. First, a reduction in average selling price of vehicles year-over-year, impacted by an unfavorable mix. Second, a decline in vehicle deliveries, which was partially due to the Model 3 updates at the Fremont factory and production disruptions at Giga Berlin. Third, a negative foreign exchange impact has shaved off about $200 million. Despite the dip in revenue, operating expenses actually increased in Q1 by 37%. This increase was driven largely by investments in AI advancements, cell developments, and other research and development projects. More specifically, R&D expenses soared by 49% year-over-year to $1.2 billion. The financial strain was further compounded by the costs associated with Cybertruck production ramp-up, which for the moment is not yet yielding big revenue. As a result of these increased costs, operating income for Q1 was just $1.2 billion, marking a 56% decrease year-over-year and an operating margin of just 5.5%. Switching gears to capital expenditure, Tesla spent $2.8 billion, a meaningful increase compared to $2 billion a year ago. This investment was for enhancing AI infrastructure, which alone took up to $1 billion, boosting production capacity and expanding both supercharger and service networks. Finally, on the cash flow side, operating cash flow was relatively low at just $200 million, while free cash flow dipped into the negative $2.5 billion. This was primarily driven by a notable increase in inventory, amounting to $2.7 billion, and significant capital expenditure we just discussed. Personally, it was odd to see such an increase in inventory level. If this was just a temporary timing gap between production and sale, it's not a big issue. Nevertheless, if this inventory buildup was due to the lack of demand, it will be a big problem. So I tried to find more clarification on this, but there wasn't much there. So we will have to see until the second quarter to find out how serious or not serious this is. And to summarize Tesla's financial landscape in the first quarter, despite facing short-term revenue challenges, the company has not only sustained, but also significantly increased its investments in R&D as well as AI infrastructure expansion. This strategic focus illustrates Tesla's long-term vision to stay at the forefront of innovation and market leadership. Next, let's delve into some highlights of the Q&A session, focusing on the latest development across Tesla's various ventures. Starting with an update on the Optimus robot. Currently, Optimus is capable of performing simple tasks within laboratory environment. But looking ahead, plans are in place to commence limited production within Tesla's own factory operations by this year's end, aiming to deploy Optimus for practical tasks. Furthermore, there's potential for external sales by the end of next year, though these timelines remain tentative at the stage. Optimus represents a transformative technology poised to significantly broaden economic possibilities, possibly overshadowing the combined value of all other Tesla products. So if you're conducting valuation of Tesla, how you evaluate this robot business will be quite important. Next, about advancements in AI and FSD. The management team claimed that Tesla's AI inference efficiency continues to lead the auto industry. This superior efficiency is poised to deliver substantial benefits across all Tesla products, enhancing not only the vehicle autonomy, but also optimizing factory operations for improved production efficiency. And regarding the regulatory process of this FSD, several states have already adapted their laws to facilitate the operational deployment of FSD. And Tesla is actively pursuing expansion into new markets, including China. Musk claimed that thanks to its human-like driving capabilities, FSD requires only minimal local adaptation to comply with various international traffic regulations. On the licensing front, Tesla moved from the initial skepticism among auto OEMs to more concrete negotiations. This shift has been aided by demonstrating the effectiveness of Tesla FSD technology, particularly within the deployment of version 12.3, which showcases autonomous driving capabilities using standard hardware and Tesla's software. The key milestone for securing licensing agreements involves proving the superiority and the viability of Tesla's technology. It must be evident that Tesla FSD system, which utilizes a low-cost inference computer and standard cameras without the need for additional sensors like LiDAR or radar, is a viable and superior solution. Once the industry recognizes that Tesla's technology is essentially more competitive, licensings will come inevitably. It will be interesting to see how Google's Waymo and GM Cruise respond to such Tesla's confidence. But unfortunately, it's harder to hear from these competitors. Musk added that any licensing agreement signed is expected to take up to 3 years to integrate into OEM products, reflecting the typical product lifecycle in the automotive industry. Turning to vehicle production, the Cybertruck has reached a significant milestone, achieving a production rate of 1,000 units per week within just 4 to 5 months of production initiation. While challenges persist due to new technologies and supplier limitations, there's ongoing efforts to enhance cost efficiency and quality. Moreover, Tesla is driving toward significant price reductions, targeting a price point of $25,000 for a new generation vehicle. These developments emphasize improved manufacturing processes like the on-box manufacturing method and reductions in power strain costs and material usage, which are expected to be integrated across Tesla's future vehicle lineup. Next, in response to the news that Tesla reduced its staff by over 10%, eliminating approximately 14,000 jobs, the management claimed that these reductions were to remove redundancies and avoid duplication of efforts, which often come with companies scaling fast. Lastly, Musk discussed how Tesla could offer cloud computing services akin to Amazon Web Services one day. He claimed that the development of distributed inference capabilities, which leverage the computational power of Tesla vehicles during downtime, might make this possible. By utilizing its fleet as mobile computing nodes, Tesla is poised to expand its AI capabilities far beyond driving. This is another positive possibility for Tesla, but it looks like there's a long way for this to become a reality. Anyways, that sums up the Q&A session, and let's take a look at some major news on Tesla. First up, the geopolitical events, specifically the Red Sea shipping attacks that occurred in the first quarter, caused Tesla to halt its production at its Berlin factory for about 2 weeks. Such disruptions highlight the vulnerability of global supply chains and partially explains Tesla's decreased revenue in Q1. Next, there were some more recalls for Tesla cars. In February, Tesla initiated a recall in the US due to a small warning lights on the instrument panel, affecting nearly 2.2 million vehicles. This recall has not only impacted Tesla's reliability image, but also led to a 2.7% drop in Tesla's share. Additionally, Tesla also recalled over 1.6 million vehicles exported to China due to problems with automatic assisted steering and door latch controls. Finally, on the corporate governance front, a significant ruling came down in the end of January, where a Delaware judge ruled against CEO Elon Musk's $56 billion pay package, deeming it excessive and improperly set by Tesla's board, which lacked independence. This ruling was the result of a lawsuit filed 5 years ago by a shareholder, Richard Tornetta, who argued that Musk had too much influence over the board's decisions. The parties have been directed to confer on how to implement the decision, potentially leading to a new compensation package for Musk. Please feel free to share your thoughts on this ruling in the comment section, whether Elon Musk is a great asset or a risk factor for Tesla shareholders, like how media portrays him to be these days. Okay, that sums up the Q1 update on Tesla, and if you want to check out our valuation on this company based on the assumption that Tesla is just a car company rather than a high-tech AI company, then check out our recent video. Also, you can download a full-fledged DCF model on Tesla that models out not just the EV segment, but also FSD, humanoid robots, etc. Check out the link below this video. Thanks guys.